What the hell is going on? I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, financial crisis protocols have been initiated as a major bank is about to collapse. I'll show you why this problem is so big that not even the central bankers have the power to stop it. Plus, the U.S. manufacturing sector is in danger. I'll show you why more Americans are soon to hit the unemployment line. Now, let's head over to Bloomberg, where we picked today's story up with a headline. As China weighs $142 billion capital injection into top banks. And I want you to compare this to what happened back in the global financial crisis when the U.S. government brought in every CEO of every major bank, locked them into the room, and forced each bank to take bailout money, when in fact we know that some of the banks didn't need money at all. And it was done deliberately to make sure the average American did not know how severe the problem was or which bank was the cause of all the problems, to avoid a massive bank run. I want you to see exactly what's going on in here in China, because we've been warning about a collapse in their banking system, and finally Beijing is waking up to the reality that's probably started. The funding will mainly come from the issuance of new special sovereign bonds. The details have yet to be finalized and are subject to change. Such a move would be the first time, again, key words, first time since the global financial crisis in 2008 that Beijing has injected capital into its banks, indicating that there are severe problems with this banking system, one which we know is actually going on because the banks in China are heavily leveraged against the property sector at a time when property values are falling. We're seeing the Chinese economy enter a recession, and consumers have turned to paying down debt and raising their savings rather than spend money. It's a lose-lose proposition here for the Chinese banks, one that is so bad that Beijing is now being forced to inject capital. The nation's top banking regulator said earlier this week that authorities would act to boost core Tier 1 capital at its 6 major commercial banks, without elaborating, suggesting that we do know for a fact that some of the banks have plenty of capital, but there is something wrong in the system, something so severe that the government has to put capital in here. Of course, the National Financial Regulatory Administration didn't comment because, again, they don't want people to know. This is a different type of stimulus. If done through special bond issuance, it's fiscal stimulus and can stabilize the banks as property prices continue to decline. It will ensure that banks' lending capability won't be affected. And now we start to get to the real picture here, that as the value of real estate goes down, that the banks are holding loans against, that the government is starting to realize the problem that we've been warning about for months. Because as asset prices go down, well, that doesn't mean the loan value goes down. And what we learned during the global financial crisis is that when values drop, people tend to stop making payments because they figure there's no chance they're going to be able to make those payments when they're about to lose their job. That means the banks, of course, have major liquidity issues. Now the government's starting to realize the economy is in far worse shape than they want to admit, because what happens next, as we've talked about, is we start to see delinquencies rise, and when that happens, banks cut their lending activity. And this is important to understand, because in a debt-based economy, you need the commercial banks to lend to create money into the economy. And if they're not lending, new money isn't created, then you have no chance of hitting your growth targets, which is highly important to the Chinese government, nor do you have enough money to pay on your existing debts. Next thing you know, the music stops and everything starts to go wrong. And we can look at the U.S. data here as we look at the commercial industrial lending data. They're shown in blue on a year-over-year rate of change against the delinquency rate on all loans, consumer loans, and credit card loans at commercial banks. Now, while all loans remain low, what's notable here is consumer loans. You start to see a trend upward in delinquency being led by credit card loans. But let's go back and look what happens, because as you see delinquency rates go up, what happens is lending goes down because banks have to put more money in reserve. So all of a sudden, when you hear, of course, Beijing come out and say, well, we need to inject capital in the banks, what are they telling you is they need more reserves. And this is a severe problem, telling us that the banks are not solvent at all. But we already knew that. And as we fast forward to the dot-com bubble, we see the same event. We see delinquencies starting to rise, and next thing you know, lending activity slows down and contracts. It happens again during the global financial crisis, but only in a more severe way. As you know, delinquency rates skyrocketed. Now we're seeing the early signs of it happen once again, and this means for the U.S. in particular, we're not likely to see an economic rebound because the banks are going to start raising more capital, and that means they're going to be buying more bonds out of fear that they're going to have to deal with all these losses. This is why we see in the banking data, and of course we'll get more of that as earnings season kicks off, that the banks are increasing their loan loss ratio. This means they're raising cash, again, buying more bonds, and you start to make sense of why the Chinese banks were buying bonds. Of course, remember, Beijing was complaining about this. They said, hey, look, we need you to lend money. And the banks are like, no, we don't want to lend money here. We want to actually buy bonds, because they already know the people they've lent money to are not in a good place. And remember, the bank's first job when they lend money, make sure they get it back. As China's mega banks have been under growing pressure from regulators to shore up the struggling economy by offering cheaper loans to risky borrowers. And of course, you start to make sense of why the banks don't want to do this. They're already seeing problems to begin with. And then the government comes in and says, hey, look, we want you to lend some money to people that probably can't pay it back. And of course, that doesn't make the banks very confident, particularly when they're already in a position of illiquidity. And then who do they want to lend it to? Well, real estate developers who can't sell homes and homeowners who are going to lose their job. This is dangerous because most recently, some of the lenders heeded government calls to pay their first ever interim dividend. So on top of the fact that the government wants them to lend to people who can't pay it back, the government say, hey, look, you need to prop your stock up and take some of the little bit of cash you have and pay it out as a dividend. The banks don't want to do that at all. But if you're looking to turn around your trading account, we've got the answer for you. Check this trade out that we put on to our subscribers on September 13. It's in uranium. It's up as of close of business yesterday, 11.46%. It was up even more at the time of recording. And you think, well, Steve, I don't have time to trade. We make it easy for you, and we have a super high success ratio. Our CTA Timer Pro, we trade against the machines. When the machines are in deep short position and price rallies against them, we flag that on our report. Right now, we're seeing an 80% win ratio of our current trades, and we dropped 3 new trades today. This gives you confidence. Now, maybe you like to trade momentum, like the RSI and the MACD. Well, we do it better because we look at multiple time periods and we run a proprietary overlay. We've got 5 open trades, 3 are up, 60% win rate. Again, 3 new trades dropped today. Here's how easy it is. Over 2 hours before market opens, we publish reports and my opinions on which trades you should take a look at. You pick the trades, put a buy it open, and then put a stop loss on it. Go about your life. Once a week, we update our stop losses. Your call when to do that. And when you get stopped out, you profit. It is that easy, my friends. You get the daily reports. You get the signals. You get my opinions. You get the back test data. You get the stop loss levels. You get the full tracking of all of our open trades and a weekly update, not to mention a 30-day free trial. Why is that? Because we know you can make money trading, and a ton of it. Links in the description below. Jump on that because we've got more stuff coming for our subscribers. You don't want to miss out. As funding is now favorable for the government. Back in May, China kicked off another planned issuance of 1 trillion yuan in ultra-long special sovereign bonds. And keep in mind, you go back to that point. What did Beijing want to do? They wanted to drive up interest rates, and they were bad at the banks. They said, stop buying these bonds. Of course, the banks needed them because they said, we don't want to lend. We're so worried about getting our money back. We want to hold bonds. We want the interest off of this. We need to raise our loan loss ratios. The banks there are largely insolvent. This is dangerous. Beijing finally waking up to the reality. The problem is, when will the rest of the world? And in theory, the big banks don't need more capital to sustain operations unless they'll be asked to take on more credit risk. Well, they don't want to do it. That's the issue. You know, banks look at getting their money back. And right now, the Chinese banks are saying, look, the global economy is slowing. We're the world's largest exporter. Our manufacturing base is contracting. More people are going to start losing their jobs if the world doesn't turn around, and we don't want to lend because we know we can't get this money back. The government's saying you need to because the economy is going into recession. You see, it's a lose-lose proposition. In this case, 1 trillion of renminbi will be more or less for that purpose as the government get this, is borrowing money to inject money into the banks. And this borrowed money, of course, when they issued the bonds, the bank said, we want those bonds, so we're going to buy them, give the government the money, and now the government's going to take that money and put it right back into the banks and try to force them to lend. The question is, will the Chinese economy hold up long enough to turn around, or will this end in disaster? I think it's going to be absolute disaster. I think the banks are going to collapse. I think China's economy is going to enter a depression. The question is, what do you think is going to happen? Weigh in the comments below. Love to get your opinion on that, because when we look back at history and we talk about the severity of this move, China first bailed out its 4 big banks in the late 90s when their non-performing loan ratio surged about 40%. So that's when we talk about delinquencies. And why is this such an issue here in the United States? Because we're seeing a rise in delinquencies. This actually gets the banks to stop their lending activity, and then you see that contraction. Now, the contraction is dangerous because when you actually see lending contract, it destroys money from the financial system, and that's how you get a financial crisis if you are lucky enough to only get a recession. The government injected $60 billion of foreign reserves in early 2000s to recapitalize several banks. In 2008, Agricultural Bank received about $19 billion in a bailout, capping a decade-long overhaul of the banking industry. And here we are just after the pandemic, when everybody said the global economy was going to boom, and China is now saying, hey, look, we're only doing this because we're falling short of our growth targets. The reality is you do not inject money into your banks unless it's a crisis issue. They know their banks are insolvent. They know somebody's about to fail, and they're trying to stop it at all costs to give consumers confidence, because once people realize banks are failing, money goes out, and next thing you know, there's a massive run followed by a huge systemic collapse. President Xi Jinping's huddle of the 24-man political bureau concluded with a promise to strive to achieve the country's annual economic goals. And of course, that means inject money into the economy. We said he was going to do it, and now it's happening. Officials pledged action to make the real estate market stop declining, their strongest value to stabilize the crucial sector after new home prices fell in August at the fastest pace since 2014. And there's absolutely no way stimulus is going to stop this, because what you need is Chinese consumers to go out and buy all of these homes that have been built that no one wants to live in. But because the global economy is slowing and they're worried about their jobs, there's no chance this is going to work. There's going to be a short-term effect like anything, but look for the stimulus to fail. And the biggest fear central bankers and governments have is when stimulus stops working. This could be, my friends, one of the first times we see the entire world come crumbling down as stimulus by governments fails. In a sign the government is increasingly concerned about economic beliefs, the Politburo vowed to strengthen aid for people with difficulties in finding jobs and lower income groups, even looking to give one-off cash handouts to residents facing hardship. And one thing we have noted is that we see high rates of unemployment for young people in China. Why is that? There are no jobs. That's the issue here. We've seen older people work longer, hang on to their jobs, because they know if they don't, next thing you know, their whole household finances is going to be a disaster. They don't have the income to pay on the loans, and the Chinese economy isn't strong enough to put all these people to work. The frequency and magnitude of policy rollouts have exceeded our expectation. The tide has turned. Be prepared for more proactive initiatives. And what that tells you is China's economy is squarely headed into a recession. And what we see is this led by the manufacturing sector. We came out of the pandemic with everyone wanting stuff. And the problem is there was so much money injected in the economy. Rates were dropped to ultra low levels. There wasn't enough supply. Well, what happened is supply went through the roof and demand crashed. Now we're seeing manufacturing sectors in every major industrialized country get hurt. And next up is the U.S. As orders for U.S. business equipment barely rise ahead of the election, though many businesses are still committed to making long-term investments, uncertainty about the November presidential election and future demand has caused firms to be cautious about expansion. That suggests factory production may struggle for momentum in the coming months. And one thing I don't buy is this whole excuse about the election of what everyone's waiting for. The reality is businesses are looking for demand, and if consumers were out buying goods and services, there would be demand in the economy, and businesses would ramp up production accordingly. But the problem here with manufacturers is they don't know why things are turning down, so they're blaming it on the election because they've been told by the Federal Reserve, we're going to have a soft landing. There's pent-up demand for consumers, and out of nowhere, it disappeared. And we can show you why demand is going to continue to decline. It has nothing to do with interest rates. As we look at manufacturers' new orders of durable goods, as shown in blue, against total income as a function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, that's shown in red. And what you can see is as income decelerate for most American workers, well, what happens is new orders decline. And we can see this relationship over and over throughout history, suggesting that any hope of a turnaround in manufacturing here in the U.S. is not going to happen because incomes continue to fall, hours worked drop, and we're going to find out soon enough more Americans are going to be on the unemployment line because if manufacturers don't have enough new orders to keep their workers busy and they run out of backlogs, next thing you know, they're going to issue a ton of pink slips. And at the same time, the likelihood of cheaper financing costs in the coming year after the Federal Reserve cut interest rates by 0.5 percentage point this month is hoped to bolster demand and encourage companies to move forward on investment plans. I'll show you why it's not likely, because there's no relationship here. You look at total income in red against the federal funds rate, and you can see there is no relationship. If you lower the federal funds rate, it doesn't cause incomes to surge. And if you want people to spend, you need their incomes to rise faster than inflation, and we're not seeing that happen. It's dangerous because right now we saw a big goose egg in durable goods orders, but because the market thought it was going to be negative, everyone championed it as of good news. But here we can see aircraft bookings with their volatile dropped a whopping 7.5% last month. And recent Purchasing Manager survey illustrated struggling manufacturing sector as the Institute for Supply Management's manufacturing gauge contracted for a 5th straight month in August, which we're not seeing in the headline government data, while the S&P Global Manufacturing September Index declined to its lowest level since June of 2023. The only question is, when is the survey data going to catch up with the government data? And then when are we going to see it in the labor market? Because that's the question, as everyone's now excited that U.S. jobless claims dipped to 4-month low, defying hiring slowdown. Initial claims decreased to 4,000 to 218,000. This, my friends, is historically low. Meanwhile, continuing claims, a proxy for the number of people receiving benefits, ticked higher to 1.83 million. So while we are seeing some people lose their job, we're seeing others go back to work, but not enough people are going back to work to offset the losses. This is dangerous. But what doesn't make sense is because when we look at continued claims against initial claims, when initial claims start going down, well, continued claims should fall. We see that relationship throughout history where you see the red line as initial claims leading, continued claims lower. In this case, as long as continued claims stay elevated, what it means is we're losing purchasing power of those on unemployment. It's going to backfeed into the economy. We're seeing it in the manufacturing sector. The real question is, why isn't it showing up in the data? Well, some suggest that claims have stayed low in recent months despite a rise in the unemployment rate and slowdown in the pace of job creation. Economists say it's because workers eligible for such benefits have not been losing their jobs, some of them going into retirement, some of them, of course, getting severance packages. Though weekly filing claims remain low, multiple large companies have announced or implemented plans this month to scale back their workforces. Paramount Global carried out a second round of layoffs, while General Motors announced last week it would temporarily lay off 2/3 of the workers at an assembly plant in Kansas until mid-next year. And all this is setting up for a huge explosion in initial claims here in the U.S. that will put more Americans on the unemployment line. Their incomes will drop, and it'll be a foregone conclusion that we're headed into a recession. But the problem is, what's happening with China's banking system is going to happen here as delinquency rates continue to rise. It won't be long before perhaps the U.S. government is looking to bail out our banks as well. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.